So imagine walking into a corporate boardroom, right? And you're about to pitch the CEO your brilliant new business strategy.
Oh boy. I mean, good luck with that.
Yeah, exactly. Because you walk in and you tell them you want to intentionally kill off several of the company's own brands.
Just right out of the gate, suggesting they shrink the company.
Right. And then you tell them you want to flat out refuse to offer discounts on your main products, even when, consumers are really feeling the pinch financially.
That's a bold move.
It gets better. On top of all that, you plan to essentially just accept flat sales in your core domestic market here in the US.
Yeah, most CEOs would literally have security escort you out of the building for a pitch like that.
I really would. But the crazy thing is, Deckers just used that exact strategy to generate $5.5 billion in a single year. And today, we're finding out exactly how they pulled that off.
It's honestly a phenomenal case study in corporate discipline. Because in a retail sector where, so many companies are just throwing everything at the wall to see what sticks, we are looking at a masterclass in highly intentional subtraction.
Welcome to the deep dive. Our mission today is to look at the hot off the press Deckers brand's fourth quarter and full fiscal year 2026 financial report.
Which was just released on May 21, 2026.
Exactly. And look, if the name Deckers doesn't immediately ring a bell for you absolutely know the shoes they make. We are talking about the parent company of HOKA and UGG.
Two massive, massive brands.
Right. And our goal today is to look beyond the physical shoes you see on the street or, constantly popping up in your social media feeds. We really want to understand the massive financial engine powering those brands.
And what this specific corporate strategy reveals about global consumer behavior right now, which is a lot.
Okay, let's unpack this, because the headline numbers in this report demand an explanation.
Yeah, so to set the baseline, Deckers posted a record $5.47 billion in full-year revenue for fiscal 2026.
$5.5 billion. Wow.
Yeah, and that represents a 10% increase from the previous year. And alongside that, their diluted earnings per share hit a record $7.02, which is an 11% increase.
Okay, before we go further, let's quickly clarify the diluted earnings per share thing for anyone who might normally just look at regular EPS. Why does the diluted part actually matter here?
It's an important distinction for sure. So regular earnings per share just divides the company's profit by the number of outstanding shares. Pretty simple.
Right, the standard math.
But diluted earnings per share assumes, well, basically a worst-case scenario for the current shareholders. It calculates the profit per share as if every single stock option, warrant, or convertible bond out there was suddenly exercised and turned into regular shares.
So it floods the pool, essentially.
Exactly. It inflates the share count to give the most conservative possible view of profitability. So when a company posts an 11% jump in diluted EPS, they are saying that even if the market flooded with all those potential shares, the profitability of the company is still growing aggressively.
Okay, that puts the $7.02 figure into perspective. I mean, a 10% revenue jump when a company is already dealing in billions is not a rounding error.
Not at all.
But to truly understand how they arrived at $5.47 billion, we have to look at what is actually in the boxes they are shipping. Because Deckers is a portfolio company, but reading through this earnings report, it is glaringly obvious that two massive stars are doing almost all of the heavy lifting.
Yeah, we are looking at a deeply, deeply concentrated revenue stream here.
Let's pull the specific numbers. So HOKA's full-year sales jumped 15.9% to hit $2.587 billion.
Just incredible growth for a running
Yeah,
share.
right. And then UGG's full-year sales increased 8.2%, landing at $2.739 billion.
Almost equal sizes.
Yeah, when you add those two together, you are essentially looking at the entirety of that $5.47 billion pie. The CEO, Stefano Caroti, specifically credited this record year to the continued momentum of HOK and the enduring strength of UGG.
Which is a very deliberate choice of words, by the way.
But wait, think about this. Selling highly technical running shoes and cozy sheepskin slippers under the exact same corporate roof. That sounds like a logistical nightmare.
It really does sound like they shouldn't fit together.
Right. It's like a barbell strategy at the gym.
Sure.
You've got high-performance athletic gear on one end and ultra-casual lounging comfort on the other. How do they not cannibalize each other's marketing or just totally confuse their supply chains?
Well, what's fascinating here is that the stark contrast between the two brands is actually the core of their defensive strategy. They aren't trying to create like a unified Deckers lifestyle aesthetic.
Which a lot of parent companies try to do, right? Force everything into one box.
Exactly, and it usually fails. Instead, they are operating two completely distinct category leaders. HOK-Con is positioned strictly as premium athletic engineering, and UGG is positioned as the ultimate premium comfort lifestyle choice.
So totally different lanes.
Entirely separate. And by keeping those identities separate, they achieve something crucial that the CEO highlighted in the report. They drive full-price demand.
Ah, okay, let's dig into that concept. Full price demand, meaning consumers are walking into stores or going to the website and paying exactly what the manufacturer's suggested retail price says,
Every single time.
without waiting for a Black Friday sale or some clearance event. I mean, in today's economy, how is a shoe company managing to avoid the discount bin?
It really comes down to the mechanics of perceived value and brand equity. When a retail brand falls behind on sales, the immediate panic response is to slash prices to move inventory, right?
Sure, just put a 30% off sticker on it and clear the shelves.
But the problem is, once you train your customer to expect a 30% discount, they will never, ever pay full price again. The brand equity erodes.
They just wait for the next sale.
Exactly. Deckers avoids this by tightly controlling inventory and focusing on what the CEO called brand building, product innovation, and category leadership.
So they don't overproduce in the first place.
Right, because HOK has cemented itself as an indispensable tool for runners, and UGG has positioned itself as an essential seasonal comfort staple. The consumer doesn't view them as discretionary fashion purchases that can just be swapped out for a cheaper alternative.
That makes a lot of sense. If you've ever wondered why you can never seem to find the most popular HOKA models on sale, or why UGGs rarely hit the deep discount racks at major department stores, well, this is the direct result of that corporate discipline.
They would literally rather sell slightly fewer shoes at full margin than flood the market and cheapen the logo.
And that strategy is clearly capturing full price demand across an expanding global audience, which brings us to the geographic breakdown of these revenues.
Which is where things get a bit complicated.
Yeah, here is where it gets really interesting. Because the geographic split, and specifically the fourth quarter numbers, present a massive puzzle.
A very counterintuitive puzzle.
Right. When you look at the full year geography, domestic sales, meaning inside the U.S., were practically flat. They increased by a microscopic 0.2% for the whole year.
Basically unchanged.
Yeah, ending at $3.192 billion. But their international sales absolutely exploded. They shot up 26.8% to $2.281 billion.
So we are seeing a very clear pivot toward the global market here. The U.S. market is essentially functioning as the stable bedrock, while international is the actual growth engine.
Right, but look at what happened in the fourth quarter. So the final 3 months of this fiscal year, Q4 revenue set a record at $1.12 billion.
A huge quarter.
Which is up nearly 10% from the same quarter last year. So record sales. Yet their diluted earnings per share for Q4 actually dropped. It fell from $1 down to 96 cents.
And their Q4 operating income dropped too. It went from $173.9 million down to $156.7 million.
Wait a minute. How does a company sell a record number of shoes, drive 10% more revenue, but actually make less money per share in that specific quarter?
It is the ultimate retail paradox. You naturally assume that top-line revenue growth automatically trickles down to bottom-line profit.
Right. More sales should equal more money in the bank.
But to solve this puzzle, we have to look at the expenses. Specifically, a line item called SG&A, which stands for Selling, General, and Administrative Expenses.
Okay, meaning the day-to-day cost of running the empire, right?
Okay.
Paying the corporate staff, marketing budgets, essentially just keeping the lights on.
Correct. Now, in Q4, Deckers' gross margins, which is the actual profit they make strictly on manufacturing and selling the physical shoe, that improved. Gross margin actually went up to 57.6%.
So the shoes themselves are highly profitable.
Very. The drop in operating income happened entirely because their SG&A expenses surged to $487.9 million in that quarter alone.
Wow, that is nearly $500 million in 3 months just on overhead and marketing. I assume this connects directly to that 26.8% international growth we just talked about.
Correct correlation, yeah. Because building an international footprint requires massive, heavy upfront capital. You don't just flip a switch and suddenly start selling 26% more shoes in Europe and Asia.
No, of course not. You have to physically go there.
Exactly. You have to secure premium retail real estate in foreign cities. You have to build entirely new localized distribution networks, new supply chains, And you have to fund massive international marketing campaigns to introduce the brand to completely new demographics.
So the Q4 profit dip isn't a sign of weakness at all. It's really just the cost of admission to the global stage.
Precisely, it's an investment.
But returning to the U.S. numbers for a second, if domestic sales are only growing at 0.2%, doesn't Wall Street usually punish a company for stagnant growth in their primary market? Shouldn't we be worried that HOKA and UGG have peaked in the U.S.?
Not necessarily, because context is everything here. Flat domestic sales in a highly volatile retail environment, while simultaneously maintaining full-price demand, means the brand is heavily penetrated but remarkably stable.
So they aren't losing ground.
Right. They have saturated the U.S. market, but they are holding their ground without resorting to those discounts we talked about. They are essentially using the massive stable cash flow from the U.S. market to bankroll this aggressive international expansion.
Oh, I see. It is like having a reliable, fully paid off rental property that generates steady cash every month, and you use that cash to go buy new properties in an emerging neighborhood.
That is a perfect analogy.
Which leads us perfectly into the balance sheet. Because if they are bankrolling all this international growth, what does their bank account actually look like?
It is the definition of a financial fortress. Let's look at the liquidity and debt profile.
Okay, so the report states that as of March 31st, 2026, Deckers holds $1.907 billion in cash and cash equivalents,
Nearly $2 billion just sitting there.
just sitting in the bank. But the most striking data point in this entire report, considering they are a massive consumer goods corporation, they have zero outstanding borrowings. Absolutely no debt.
That is incredibly rare for a company generating over $5 billion in revenue.
Really? Why is that so unusual?
Because usually, large corporations leverage debt to fund expansion. Debt is often cheaper than giving up equity. To operate at this scale entirely debt-free provides a level of agility that most of their competitors simply do not have.
Wow.
And furthermore, they generated over $1 billion in free cash flow in fiscal 2026 alone.
Let's break down free cash flow, actually, because it's a term that gets thrown around a lot on these earnings calls. What does that actually represent in the real world of making and selling footwear?
Free cash flow is exactly what it sounds like. It is the net cash a company produces from its core operations, minus all the capital expenditures required to maintain or expand its asset base.
So it's whatever is left in the register after all the bills are paid.
In simpler terms, yes. After Deckers has paid for all the raw materials, paid the factory workers, paid the executives, paid the marketing agencies, and paid to open all those new international stores, they still had over $1 billion in pure, unallocated cash left over at the end of the year.
And what a company chooses to do with that unallocated cash tells you everything you need to know about their strategy.
Oh, absolutely.
Because during this fiscal year, Deckers took $1.075 billion of that cash and repurchased 10.5 million shares of their own stock at an average price of $102.43 a share.
Massive buyback.
And if that wasn't a big enough statement, the board of directors just authorized an additional $3.5 billion for future share repurchases, bringing the total authorization to $5 billion.
The CFO, Steve Fashing, specifically cited their financial fortitude and industry-leading operating margins as the foundation that makes this kind of move possible.
To really grasp the weight of a $5 billion buyback, we shouldn't just look at it as a corporate accounting maneuver.
No, it's much bigger than that.
Think of it like a highly successful small business with several partners. If the business is throwing off massive amounts of cash, the managing partner could take that money and try to start a completely different business in an industry they don't know, right?
Which happens a lot. They get distracted.
Or they could use that cash to buy out the silent partners. And by buying out the silent partners, the remaining owners suddenly get a much bigger slice of the future profits without having to change the business model at all. That is essentially what Deckers is doing on a multi-billion-dollar scale.
If we connect this to the bigger picture, it is the ultimate signal of corporate confidence to Wall Street.
A flex, basically.
Exactly. When a debt-free company with $1 billion in free cash flow announces a $5 billion share buyback, they are making a definitive statement. They are saying, we have looked at the entire market of potential acquisitions, we have looked at all the ways we could spend this cash, and we firmly believe that our own stock is undervalued.
We are our own best investment.
Right. We are the best investment available. By reducing the total number of outstanding shares, they automatically increase the earnings per share for everyone left holding the stock, making the company fundamentally more valuable per share.
So they aren't looking to acquire the next trendy shoe startup. They are doubling down entirely on themselves.
Which is very smart.
But that level of focus requires intense discipline, not just in what you buy, but in what you are willing to let go of. Because hidden in this report is a stark reality for the parts of their business that aren't HOK or UGG.
Yes, the portfolio is undergoing a very intentional reduction.
The report breaks out a category simply called Other Brands, and the net sales for other brands absolutely plummeted for the year, dropping 33.9% down to $146.2 million.
That is a huge drop.
But the report goes out of its way to note that this wasn't an accident or a failure of marketing. This decline was intentional, driven by the phase-out of the Koolaburra brand's standalone operations and the sale of the Sanuk brand.
So they are actively cutting ties.
Yeah. So what does this all mean? They are voluntarily walking away from over $100 million in revenue.
This raises an important question about the psychology of corporate management, specifically the sunk cost fallacy.
Yeah.
In a large portfolio company, when a secondary brand starts struggling, the natural instinct of a board of directors is to throw money at it. They think, we spent millions acquiring Sanuk. We have to hire a new marketing team, redesign the shoes, and turn it around.
Because nobody wants to admit they made a mistake.
Exactly. It is incredibly difficult to admit that a brand simply isn't going to be a global powerhouse.
It takes a lot of nerve to look at a brand generating revenue, even if it's struggling, and say, you're a distraction, we're cutting you.
But that is the secret to their margin expansion. Think of it like a chef reducing a sauce on a stove. If you leave all the excess water in the pan, the flavor is diluted and weak. But by letting the secondary elements like Sanuk and Koolaburra evaporate out of the corporate structure, what remains in the pan are HOK and UGG is a much more concentrated, potent, and highly profitable financial asset.
That's a great way to look at it.
They are stripping away any operational drag, so every ounce of corporate energy goes into their two global engines.
And that reduction strategy sets the stage for their future outlook. In this report, they didn't just look backward at 2026. They laid out the map for fiscal 2027.
Which is pretty optimistic.
Very. They expect revenue to climb again, projecting between $5.86 billion and $5.91 billion. They anticipate HOK will grow by low double digits and UGG will grow by mid-single digits.
Right.
And they went even further, providing a multi-year framework through fiscal year 2030.
Which is an absolute eternity in the retail space.
Right.
Projecting 4 years out in footwear requires immense confidence in your structural foundation.
Because through 2030, they are forecasting high single-digit sales growth annually, and they plan to maintain operating margins in the low 20+% range.
Steady and stable.
They are telling investors, we aren't aiming for chaotic, hyper-growth spikes. We are aiming for relentless, highly profitable, debt-free compounding over the next 4 years.
And achieving that 2030 vision relies completely on maintaining the discipline we've unpacked today.
They can't lose focus.
No. They must protect that brand equity at all costs to ensure consumers keep paying full price. They must successfully execute their expensive international expansion to offset a saturated U.S. market.
Right.
And they must protect that balance sheet, refusing the temptation to take on debt for flashy acquisitions.
If you step back and look at it, this report is essentially a textbook on modern corporate strategy. You don't try to be everything to everyone. You build distinct category leaders with premium positioning.
You maintain zero debt to give yourself ultimate operational flexibility.
Exactly. You use the steady cash flow from a mature domestic market to fund aggressive international infrastructure. And critically, you have the unsentimental discipline to prune away the brands that distract from your primary mission.
It is a brilliantly executed strategy. However, as we synthesize all this data, there is a fundamental risk embedded in this report that the math alone simply cannot solve.
Okay, what is the blind spot here?
Well, Deckers is projecting steady, highly profitable growth all the way to 2030 by placing almost all of their chips on just 2 brands. But the retail sector, and footwear in particular, is dictated by the notoriously unpredictable whims of human culture.
Right. Consumer tastes don't always follow a multi-year financial framework spreadsheet.
Not at all.
Yeah.
What is considered an essential premium item today can become outdated surprisingly fast.
Yeah, fashion is fickle.
Precisely the point. What happens if the global culture suddenly decides that maximum cushion, highly engineered running shoes are no longer the aesthetic standard?
Or what if a sudden shift in casual fashion renders sheepskin boots totally obsolete?
Exactly. Having zero debt and a $5 billion share buyback program is an incredible financial shield. But can financial fortitude alone protect a company if the cultural winds completely shift against their two core products?
That is the big question.
That concentration of revenue is their greatest strength right now, but it is also their single point of failure.
It is the ultimate stress test. They have built an impenetrable financial fortress, but the foundation of that fortress rests entirely on whether millions of people around the world continue to wake up every morning and choose those specific shoes. It is a fascinating dynamic, and we will undoubtedly be watching how they navigate this multi-year roadmap.
It's going to be really interesting to watch.
Thank you for joining us on this deep dive. The next time you lace up a pair of running shoes or see an ad for comfortable winter boots, we hope you look past the logo and consider the mechanisms at play. Consider the pricing strategy, the international supply chains, and the massive disciplined financial engines operating silently behind the brands you wear every single day.